What's up, millennials? Are the suits actually screwing us? Because it looks like there might be something unfair going on in the SPAC market, and I would like to talk about it. In February, I did an interview with Mark Hake. Mark Hake is a SPAC analyst who writes many articles about SPACs. And in this interview, we talked about the PIPE deals. PIPE deals are the private investment in public equity. So what this means is that there are private investors who can get in at $10 per share, and then the cash that the SPAC raises that way can be passed on to the company they are going to merge with. I'm going to play a portion of this interview, and then I'm going to provide you with some additional comments from my side, and I'm going to put the link to the entire interview in the description as well. All right, I'll see you in a few minutes.
The problem I see with SPACs, let me just go before I
Yeah.
said that there's some issues. The main
Right.
problem I see with SPACs are that the sponsors of these deals are normally getting a higher percentage than they would normally get than, let's say, if it was an IPO deal. And the PIPEs, the private investment in public equities that are making investments in these SPACs, are getting sweetheart deals right in front of everybody that I don't think can last. The sweetheart deal is they get to invest in almost every one of these deals at $10 per share, even when the SPAC is trading at the announcement time at $15 or even $20 per share. So at some point, there's going to be a situation where the SPAC investors will simply turn down the deal because the PIPE investors are getting too much of a cut, if you will, out of the deal. That may happen, or if somebody's really smart, they'll put together a fund where you can invest simply in the SPACs, in the PIPEs that are doing these SPACs. In fact, I'm looking for one right now. So these SPACs basically are putting up capital, and they have the same deal as everybody else, except they're getting guaranteed that they get to buy in at $10 even when the merger closes. And by the time the merger closes, if it's anywhere near a successful deal, it's going to be way above $10. Right. So they have almost no downside risk from my standpoint.
Yeah.
They can literally just borrow the money, and they probably almost all of them are just going out and getting a line of credit just to do every particular SPAC deal without even having to actually have the cash in their bank.
Do you think these sweetheart deals, as you call them, could be actually an issue for the retail investors, people like me and the people that watch my videos?
In what sense? Well, the SPAC investor normally, as a group, aren't normally as a total post merger ownership stake, normally not more than 20 to 25% of the total deal. Right. For example, the private company usually gets anywhere from 50 to 80% of the deal. The sponsor gets maybe 5%, and the SPAC might get 10 to 20 to 30% of the deal.
Yeah. Right. Makes sense.
Now, what I like are SPACs where there is no PIPE. There was one real famously, and I mentioned this to you the other day, Lancandia, which did the Golden Nugget gaming, online gaming. They avoided that because the sponsor was a very astute gentleman, Tillman Fertitta, who recognized this. It took a while for the SPAC to actually pass the merger because the PIPE wasn't there to actually sign up for the deal and give enough votes to get the deal across the line. However, now the SPAC investors own a much larger percentage of the company, so they'll get a larger percent of the total earnings. And if the company decides to raise any more capital, it'll be at a market price.
Right. Okay. Do you think we should get rid of these PIPE investments altogether, or just change the rules maybe? Or
well, again, there's a trade-off because the private company is only willing to do this. Typically, the PIPE will add in anywhere from 50 to 100% of the amount of money that the SPAC itself is providing.
Right.
So it's essentially a guaranteed deal for the private company to know that the SPAC money is there for them and the PIPE money is there for them. They can maybe even go out and get a bridge loan immediately once they sign the deal. But I do think that there should be some more scrutiny by the market, not by regulators, because regulators would just mess it up, on how pipes and the sponsors themselves are getting remunerated in this whole process.
How could people like me do that?
Let me give you a real good example. This
Yeah.
Lucid deal with CCIV.
Yes.
If they pull this deal off, and by the way, it's based here in Phoenix,
Okay.
just down the street.
You mean CCIV or Lucid?
Yeah, Lucid is in Casa Grande, which is
Oh, okay.
50 miles south of Phoenix. It's
Can't you go check?
It's halfway between Phoenix and Tucson.
Can't you go check if they're actually going to work with CCIV?
By the way, Nicola's building a plant in Casa Grande too.
Should go to Trevor Milton.
Here's the thing. If that deal, where's the stock at right now? $24 or something like that?
I think even higher. I've seen it at like 34 or something like that.
There is no way they can allow a pipe to come in at $10 if that deal gets closed. That would be, to me, just beyond ridiculous. Okay, do you see what I'm saying? How could they in all good faith say, okay, we've got 500 million in the SPAC, but oh, by the way, you can come in here at $10 and you get to make more than 100% on your money just for saying you're going to put up the money. You know, if I had $500 million, I would call them up that day and say, stop. I'll give you the deal at $15.
Right.
In fact, at some point that will happen.
But you're saying it should not be regulated, I believe, right? I think you've just said something about regulators that they should not be the ones
work this out. You know what I mean? You got to let the market come up and say, okay, you might have more of an auction process happen for the SPAC or the pipe deal to happen. Or force the pipe to, I don't know. There's got to be some more conditions put in it, I would think. But if whoever's running Lucid allows a pipe to get in there at $10, to me, that would be the ultimate sort of, these guys don't really care too much about shareholders. That's what I would say.
So as you've now heard from Mark Haig himself as well, there are pipe deals going on that simply look like sweetheart deals. These pipe investors can simply get in at $10 per share even if the stock is already trading way higher than that $10 per share. There's basically no downside risk. They can even go ahead and borrow money from other people to get into that SPAC and almost instantly make money. It's almost a little bit like a machine where you put $10 in and you get $15 in return, or $20 in return, or $30 in return right away. And the comment about Lucid Motors from Mark was actually very on point, because the interview was actually recorded before this deal was announced, and the pipe deal from Lucid Motors was not $10 per share, but was actually raised to $15 per share. But that still meant that the pipe investors were getting a very great deal, because they were just putting in $15 per share, while the stock was already at $40, $50, even $60 per share. Of course, it has corrected a little bit, but it's still around that $30 per share level. Now, I will say this because usually there is a lockup period. The pipe investors usually have to lock up their shares for about 6 months, usually 180 days. So of course, that is a slight risk. They do need to keep holding those shares for 6 months. So the question then becomes, if this is a problem, what could be a potential solution for this problem? Could we maybe get rid of all the pipe investments altogether? Well, the problem is, yes, on the one hand, it is maybe good for SPAC investors because they can get a larger share of the pie. But on the other hand, pipe investors do bring in quite a lot of money that goes to the balance sheet of the company the SPAC is going to merge with. So if there is no pipe investment going on, then the company is going to have less money on their balance sheet. Should we maybe then regulate everything? Well, as you heard from Mark Haig, this probably is not a good solution either, because the regulators just screw it up anyways. Now, Mark suggests that this could maybe be solved by the market, and it's not entirely sure how it would be solved by the market, but I think the fact that we are talking about a private investment in public equity already makes it quite difficult, because people like you and me cannot invest in such a deal. I think if you would have a more open, a more free market with just supply and demand, then I think the price would be very much closer to that market price instead of just a fixed dollar amount of $10 per share or $15 per share in the case of Lucid Motors. So by opening up the pipe market, maybe we could get to a sort of auction process where everyone can just bid on the pipe deals. And then because of supply and demand, I think that the price would actually be a little bit more reasonable than the prices we have got going on right now. Another potential solution could maybe be to raise the amount of shares from the SPAC. So then you would have a larger portion of that SPAC, but you would also have more money that the SPAC can actually pass on to the company they are going to merge with. And this is also going to lead to a higher percentage of ownership by the SPAC investors, people like you and me. So yes, I do think there might be potential issues with these pipe investments, and I would like to know your opinion as well. What do you think could be a potential solution to this problem? Let me know in the comments. And with that being said, thank you very much for taking the time to watch this video, and I hope to see you in the next one. Bye bye!